think the most important thing to think about when you're building a portfolio is first, what problem are you trying to solve? What goal is your client or the investor trying to achieve? And I think active or passive is really a secondary consideration. You first have to start with what asset classes, what exposures are going to get me the highest chance of achieving that outcome. Once you've decided on the asset class exposure that you'd like to have, I think that's when you really need to start asking the question, active versus passive. And to me, there's a whole bunch that gets thrown into that bucket. First and foremost, is it possible to find an active manager that you think will consistently deliver the returns you're looking for? Another way to ask that is, can a passive manager actually accomplish what you want them to? In some asset classes, the answer is yes. In others, it may be no. When we think about the role that active management can play in a portfolio, it's really twofold. One is making sure we get the exposure we want, and in some things like the emerging markets or high yield, both debt and equity, right? It's hard sometimes to say I can buy an index because this stuff isn't always liquid. It doesn't always trade the way we want it to. And without somebody actually in there making active decisions, I'm not sure you're going to even get what you think you're going to get. But the second reason is really when we look at our expected returns from a diversified stock bond portfolio, let's use the sort of typical 60-40 diversified portfolio, without any active returns, we don't think we're going to get returns much higher than 5 or 5.5% over the next 10 years. And so if you're even able to add 50 basis points or even 100 basis points of additional return after fees, which we do believe is entirely possible, that can make an enormous difference in someone's life. We get asked the question a lot, should I be active, should I be passive, how do I think about it? And the answer is yes, you should be using both active and passive. It's really a question of where do you want to spend your fee budget, where do you want to spend your time, and where do you want to spend your risk budget? And I think there are a lot of myths around index investing or passive investing, and one of my favorites is indexing means never having to say you're sorry. That is true if all you're doing is comparing your specific return to the index's return. And it is true, if you are indexing something well, you shouldn't have any big surprises. Your returns will be the index minus the fees. I will say, though, that not all index managers actually are able to consistently execute that, and there are some pretty famous examples of index managers actually underperforming their indices. So that's nasty surprise number one. But nasty surprise number two is that all you are getting is the index, and there are all kinds of environments that an active manager can take some different decisions. We certainly think the broad fixed income market is one that is generally speaking very difficult to index well, and one that could give some very unpleasant surprises to some investors depending on how the rate cycle evolves. And I think one of the reasons there's so much focus on this active-passive debate is because we have given our clients and advisors in the media incredibly precise ways to measure failure. You can do it on a daily basis, on a weekly basis, on a monthly basis, on a quarterly basis. And it's really important for people to know they're getting what they pay for and that there's value in the manager that they've chosen. So it is, on the one hand, a good thing that we can measure this stuff. But I do think the focus on statistics and metrics that have nothing to do with whether or not I'll be able to retire when I want to, fundamentally takes us away from the right conversation, which is how are you risk aligned at the total portfolio level, and how are you generating that return, and what kinds of risks are you comfortable with? And I think we all need to do a better job of taking a big step back and kind of stepping up a level to try to help our clients understand some of the broader drivers of this.